If you ask me what I think as opposed to what the Fed thinks, my expectation is here at High Frequency Economics, what we're telling our clients is that we're not looking at a wage price spiral, at least not yet, and the Fed is doing its job to prevent that from happening. But we're looking at a reaction to the explosion of money that was generated, that was created by the Fed in response to the COVID lockdowns. And that excess amount of money in the economy has led to excess spending beyond the economy's capacity to produce, and that's what's driving prices up. Where we are right now, we've got a percentage point gap between price increases and wage increases. You can't explain 6% price increases with 5% wage increases. It just doesn't add up. So if you ask me, what we're going to experience is a stabilization of prices at current levels, which means the year-over-year change in prices that people think of as inflation is going to drop off over the course of the year. That's going to make real interest rates very, very high. And we may get a recession out of that, but we'll get that recession closer to the end of the year rather than at the beginning of the year as real interest rates start to bite.
Carl, what we're talking about here is a very different scenario around inflation for a lot of policymakers. And Neil Kashkari over at Minneapolis was talking about this, comparing it to Uber price surging. So if we can call it maybe Ubernomics here, that you've got this a very strange environment, prices, profits, wages all going up, and you have that supply gap. But can the traditional method of jacking up interest rates really deal with this type of fundamentally different inflation?
Yeah, I mean, my personal view is that the Fed's quantitative tightening, its sale of bonds from its balance sheet, thereby reducing the money supply, that's much more important to getting prices stabilized right now than the hike in interest rates. But the high interest rates for longer is also important because the labor market is tight, despite the jolts. The jolts numbers tell us that there are still a lot more jobs available than there are workers to fill them. So the Fed wants to make sure that a wage price spiral doesn't occur. To rise to the point that Steve made a few minutes ago, yes, the labor market is tight, but that's what was causing. It was a wage price spiral that caused inflation back in the 1970s. But I believe that what caused prices to rise over the last 2 years is more an excess of demand over supply caused by printing too much money, and it's a different process. It's something we've never seen before, and I think policymakers are putting out two fires at once. They're trying to dampen demand by withdrawing the excess liquidity from the economy. That's the QT bit of it. And then they're also trying to keep the labor market from overheating, which it is on its way toward, but not quite there yet, by raising interest rates.
Dig a little bit deeper in the demand story, it feels as though we haven't seen that switch yet to the post-COVID style behaviours, supersized spending, first on products then on services. And a lot of central bankers are watching some of these patterns very closely. It feels as though the C-suite has just caught on this year and looking ahead, hence the level of layoffs we're now seeing from major firms, from the likes of Amazon to Salesforce. But when do you think those behaviours flip back, where people first up are willing to pay for more to have access to certain services and products, and down the track they simply cannot because the fundamentals of their own balance sheets catch up with them?
Yeah, so the labor market is the real tight knot in the middle of this whole conundrum here. You know, the labor market is tight. And even though we are seeing layoffs, 18,000 layoffs in an economy that creates 250,000 unemployed people a week, well, that's not a very, very big number. We get a lot of anecdotal evidence, but the big picture in the labor market is that, right, for the moment at least, there are more jobs being offered than there are people available to fill them, and that's a sign of labor market tightness. So yesterday's JOLTS data confirmed that the Fed is on the right track by worrying about the supply of labor eventually leading to increases in wages. But for the moment, at least, the wages are not dominating the picture. As an economist, you would like to think that as the economy slows this year, and we think it will, we don't think it's going to have a recession, certainly not in the early part of this year, and possibly not at all. All right, as the economy slows, the labor market will loosen up, and then we'll start to see some of those wage pressures coming off, and that'll give the Fed the signal that it needs toward the end of the year to maybe flatten out the trajectory of interest rates. But we don't see rate cuts coming with the unemployment rate as low as it is right now, not in 2023.